Hi, welcome to the Numerics video blog. I'm your host, Jim Joffel. Joining me today, Udi Sella from Numerics, FX expert. Udi, how are you?
Very well. Thank you for having me, Jim. Good to
Thanks
be here.
for joining us. So we've just passed midterm elections here in the U.S., where we've seen significant change in terms of the Senate and the House, as well as we have the pending G20 summit coming back off the heels of the original call for global derivatives reform, and yet we're now back in a state of flux in some way with pending changes or lack of change into market infrastructure. One of the things I wanted to talk today about with you, Udi, was there was a great article that came out in Business Week, and it said, "Did banks' rules kill liquidity?" Volcker Frank respond. And this was in Business Week, October 20th. And the basic premise of this article was talking about how the rules, how the Volcker rule and elements of Dodd-Frank were handcuffing banks. Perhaps you could give us a brief summary of some of the topics covered in this report.
Yes, sure, with pleasure. So basically, what we read in this article is that there is an ongoing debate whether the regulations that have been instaured since the subprime crisis, the various components of regulation, ha- have they made the market more secure? And is it at the cost of actually hampering liquidity and as a result, increasing volatility in the market, which is not necessarily good for the small investors that regulation was set in the first place to protect. So that's basically the two sides portrayed in this article. Some claim that given the lower appetite for banks for risk, coupled with the higher costs in terms of regulatory capital for holding positions, basically, in some cases, eliminated or limited the capacity of banks to make markets. And basically, as a result, where everyone was selling stocks or buying government bonds, the price gaps were observed in the market. And there were investors, typically hedge fund investors and portfolio managers, that claimed that reduced liquidity hampered their business. Other people say that in fact, specifically taking the example of government bonds, one of the ways to measure how liquid the trading is to measure in terms of how many days would it take to mitigate the overall government bonds position, typically U.S., uh, where at the height of the subprime crisis, this was measured in over 500 days. And since then, we're seeing an average of 300 to 450 days. So these people say that actually it's not true that liquidity was hampered. You can argue against that actually looking at government bonds, that which is indeed the U.S. government bonds are the most liquid financial asset in the world. Is that necessarily the asset you want to quantify, or is it just stocks or CDS, etc., or foreign exchange contracts?
Well, one of the questions that you make me think about is also running up to the global financial crisis, the markets were so flush with cash. So regardless of the fact that you know there was this innate sense that some of the products that were being invested in were risky, and that there were different elements of of bubbles starting to show. It was that the markets had to move them, but they put their money somewhere. Are we starting to see that same dynamic today, where investors are really in search of yield?
In my personal view, is absolutely yes. Um, I think that we're starting to see bubbles, such as, or if you like, financial prices distortion. So look at the yields, for instance, of euro-denominated bonds. Uh, it is quite surprising. Let's put it this way: that, for instance, in France, the government bond yields are about half of the yield of the U.S. bonds for the same period, or the UK government bonds, which is kind of surprising if you quantify, the economic state and even the unemployment market, the prospects, and so forth. Also, you can even look at the real estate prices. For instance, it was just published last week that the real estate prices in London went up in the last 12 months by 20%. Obviously, the salaries, or if you like, the CPI didn't go up as much. So yeah, I do think there is a bubble. I think although the U.S., or if you like, the Fed has announced that it's stepping out of the QE, actually Japan has increased the amount of quantitative easing. So we've seen, of course, the yen weakened by an additional 5 yens, or 4.5%, and currently the rates in Europe are maintained at 0.05 basis point, basically. So yeah, I definitely think there is a bubble and a price distortion.
And then additionally, we're starting to see some easing on lending. So one of the elements of Dodd-Frank and even conversations with the ECB is the reintroduction of securitizations back into the market. I think we're seeing upticks in CDOs and other securitized securitized products, which are at least then allowing some of the banks to take elements off balance sheet and then free up some lending. So we'll probably start seeing liquidity filtering down a little bit more, to the individual investor. While hopefully we won't see over increased leverage on individual balance sheets. But it seems like a lot is moving, and as we are hitting particular milestones and timeframes, the de-risking of the industry is working, but at the same time, the ongoing need for functional markets still exists. So, Udi, I want to thank you so much for joining us today and giving us a little bit of light into the issues of liquidity into the marketplace at this point in time. Definitely want to follow it up with you again as it relates to different elements of bubbles that are popping up that you particularly mentioned. But I think as we're coming into the year end for 2014, there'll definitely be some more interesting conversations, especially around the G20. So I want to thank you for your time today, sir.
Thank you, Jim. And of course, we'll see. It will be interesting to see the impact of the midterm elections on exactly those topics.
Excellent. Well, again, we always want to talk about the items you want to talk about. Please feel free to follow us on Twitter at MX Analytics or on LinkedIn, where we regularly post. And if you have any feedback for us, let us know. And Udi, we'll see you next time.
Thank you very much. Goodbye.